we need to understand what a great rental market is, okay? What's the definition? If you want to build a rental portfolio, you need to invest in markets where the rents are high, but yet the property prices are still low. What I mean by low is under 200,000. So the sweet spot to buy a single family home should be below 150,000, okay? And you expect that to appraise at over 200,000 once you do all the repairs, okay? So keep that in mind. Less than 150,000 purchase price, all in with the rehab, and then the property should appraise for at least 200 and up. Okay, that is the rule of thumb. Another rule of thumb that you need to understand is that if the total purchase price plus rehab is 150,000, then you should collect in rent 1% of it. So that'll be 1,500. So that is so critical for you to understand, because what we're going to do is we're going to find great rental markets where the rents are very high, but the purchase price is still very high. So the numbers are not going to work. Let me give you an example. For instance, Evanston. You can purchase a single family home for up to 400, 500,000. The rents are 2,500, right? So it's half a point. It's half a percentage. You've got to use the 1% rule of thumb, okay? If you buy something for 100,000 all in, purchase price and rehab, you should collect at least 1,000 in rent. So having said that, what we're going to do is we're going to categorize the areas, okay? So we're going to have 4 categories. A being the most expensive, the most desirable area, like Wilmette, Glencoe, Norbrook. Those are the areas that are super expensive, right? Very safe, great schools. But the problem is that the numbers don't make sense, right? Even if you do a flip or a rental, the numbers just don't make sense, right? It's too risky. The rent is not going to cover for your mortgage, okay? Then we have the BC areas, which are in the middle, bread and butter, we call them. And finally, you have the D areas, okay? D areas are distressed, okay? They lack infrastructure, employment, crime might be high, schools are not the best. Okay, so we're gonna be working primarily on BC areas. So B areas are great areas, okay, where the property prices are still very reasonable on the 150,000 and the rents are still high, right? You can collect 1,900 per month in the B areas. Now we have the C areas. The C areas are a little bit more challenging, okay? The crime might be a little bit higher, the schools might not be as good, but still, rents are strong and the property prices are still very reasonable, under 200,000. So we're gonna go ahead and find the top rental markets in the B markets and C areas, okay? So how do we do that? What I'm doing is I'm opening up ChicagoDealVault. So this is a system that we built that allows investors to find deals, analyze them, get funding, and understand the areas, okay? So I'm gonna click on area reports, and I will just randomly click on one of the reports just to show you the type of information we've compiled for you. We've analyzed over 300 areas and neighborhoods, okay? So I'm just gonna pick, for instance, the first one, Allsip, okay? Just to give an example, what we like to see in an area. So instead of doing driving for dollars, you're gonna see the area and learn everything that there's to know about it in 2 minutes, okay? So we're gonna give you the geographic location of the area, in this case, Allsip. Then we're gonna highlight some of the factors that are gonna affect your property values, okay? Like highways, near airports, rivers, things that will impact your property appreciation. And then we're going to give you the area in a nutshell, okay? So what's really critical, friends, is the livability score. As you can see, this is the overall summary of the area. Anything over 65, between 65 to 75, it's a C area, C plus. Anything between 70 and 80, it's a B plus. Anything over 80, it's an A area. So we're going to be focusing on livability scores between 60 to, I would say, 75. Okay, so those are going to be BC areas. So as you can see, everything is great here. The only thing that it's lagging behind is sources of employment. But other than that, education, crime, cost of living, amenities, housing, everything is really good. And then we can go into more details right here, but at the bottom, we're gonna give you the conclusion, okay? So the crime, for instance, the red line is the average. So there's certain crime types that are higher than the average. And then we have a heat map. So the heat map is fairly clean. Otherwise, you would see red and orange spots. Schools, black markers are still okay, schools. And then we give you more of the demographics, such as household income. It's almost about the median in Illinois, 53,000 versus 57 in Illinois, the median household income. Okay, if we scroll down, population growth, it's, I would say, stable, negative 1.7, so it's almost zero. So there's no migration or people moving in or out of the area. So it's fairly stable. Industry, this is going to give you a breakdown of the type of employers that are in the area. One that stands out is 18% right here. It's education. So you're going to see schools, hospitals in all SIP. Now, this is something that is very critical if you're going to do rentals, okay? We give you the vacant housing units by percentage. So at this point is 6% in the last 12 months in all SIP. So any area that has a vacancy rate less than 10% is great for rentals. And right here we have the renter occupancy rate is 34% versus 59 of owner occupancy. So obviously the higher the owner occupancy, the better, because there's spread of ownership, right? And then when you have a high renters occupancy, you're going to have a lot of turnover in your unit. So people are going to be moving in and out quicker, which means more expenses for you and more vacancies. So this is a fairly stable neighborhood. Therefore, this is a B area and we recommend cash flow. So this is the conclusion of all the details shown up above, okay? Now, we're gonna analyze the sales market analysis in the last 12 months. So what has happened in all SIP for the different property types? So we divided by 3. Multi-unit, attached means condo, duplexes, townhomes, and then detached are single-family homes. Something that you need to understand right here is the sweet spot to buy. What is it that you need to buy the property for? A single-family home in all SIP should be bought for less than 149,000. A condo less than 62,000. Okay, very simple. And at the bottom, we're gonna even give you the number of flips. But today's topic is on rental market, so we're not gonna cover the flipping markets. Okay. In fact, we're having an event, a live event on Sunday, and all we're gonna be talking about is flipping markets. But today's topic, we're gonna be focusing on rental markets. So here we do the analysis of the rental market for this area in the last 12 months. So this is going to help you understand if you have a property for rent, how long is that going to be on the market for? A month, 34 days. What are the ongoing market rents for a 2-bedroom and 3-bedroom? What are they renting for? So the median for a 2-bedroom is 900, a 3-bedroom is 1,800. This is sort of like the breakdown of the rents and below the conclusions. So rents could end up being high and they stay in the market for about a month or 34 days. So as you can see in just a couple of minutes, you are going to have a very deep knowledge of what the area is all about. So having said that, the next question is, okay, so there's no way I'm gonna go out and look at every single report. Exactly. So what we're gonna do is, we're going to find the top rental markets by area type. So we have the 4 area types that I mentioned. We're going to be focusing on the bread and butter and more of the challenging areas, which are C. But the D are like sort of the Wild West, okay? So we're going to stay away from D and A. We're going to be focusing on identifying the top 5 rental markets in the B area. So very simple. You select the area type and the approach, so cash flow, right? And then I'm going to click on search. We're going to get all the list of the areas. What I'm going to do next is I'm going to sort these by rental income for a 3-bedroom from highest to lowest. So I want to know the areas that collect the highest amount of rent, but yet they still sell for very reasonable. So we're going to be looking at two columns. This median rental income for a 3-bedroom, $2,750, but we're also going to be looking at this column, sweet spot to buy a detached or single-family home. So in this case, in Evanston, you pay $525. That's sort of the medium sales price for a 3-bedroom in Evanston, so it's quite high, and the rents also are high. However, remember the rule of thumb, 1%. So if you pay $500,000, you should collect at least 1% of it, which is $5,000 in rent. You're collecting about half of it, $2,750. So basically, if you don't meet the 1% rule of thumb, your numbers are not going to work. You're going to be losing money. So your mortgage, your operating expenses to run the property are going to be higher than what you collect in rent. Therefore, you're going to be losing money. Okay, so what we're going to do is very quickly just go down the list, and I'm going to be focusing on the purchase price. So these are 500, 300, 400. So these are all very high except this one. Check this out. Berkeley. Purchase price for a 3-bedroom, the median is $157, but yet look over to the rent collection for a 3-bedroom, $2,100. You see that? You see the power of this? So what does that mean? That in Berkeley, if you purchase a property for less than $200,000, you're going to be collecting rent over $2,000. You see the power of this? Because here, if you buy, pretty much, if you want to collect a little bit, or just look at this one, you want to collect about the same rent, $2,200, but in this case, in Edison, you're going to be paying $360,000. Okay, what about this one? Norwood. You're going to be collecting about the same rent, $2,100, but you're going to be paying over $300,000 for exactly the same property. Therefore, Berkeley is going to be, make sure you write these down. In fact, I'm going to put it on the chat so everybody has it. So what I'm going to do is, so everybody has that, I'm going to say top B rental markets. Okay, so number 1 is going to be Berkeley. Now let's find number 2. Okay, so I'm just going to go down the list. So here we have another one, Hillside. Purchase price $160,000, and you're going to be collecting $1,950. So that's the second place. So Hillside. Okay, that is the second stronger, the second strongest rental market. Okay. Hillside. I'm just going to go over to the next page because, as I told you, we need to be investing in properties that are less than $200,000 for the purchase price. So I'm going to go over to the next page, and boom, I hit another one. Sweet spot to buy in Bridgeview is $136, and you're going to be collecting $1,815. So that becomes our number 3 market, Bridgeview. Okay. I'm going to go down the list. Bingo, Allsip. Allsip is our 4th rental market, okay? Allsip, you pay about $150,000 for a property, and we just saw that, right? You're going to be collecting about $1,800 in rent for a 3-bedroom. And then let's find our 5th top rental market. So if we go down the list, these are very expensive, over $300, $200. So let me go to the next page. And the next winner is going to be, these are all over 200,000. So let me go to the 4th page. Okay, bingo, 189. So this is under 200,000, Streamwood. So we're gonna rate Streamwood as our top 5th rental market. Okay, you saw how easy it is, friends? We just identified the top B rental market. So friends, if you want to build a multi-million-dollar portfolio and scale quickly, those are the markets where you need to invest. Berkeley, number 1, Hillside, Bridgeview, Allsip, Streamwood. Why? Because the purchase price is still very, very reasonable for the type of rents that you're going to be collecting. So you're going to be collecting close to $1,750 rents and up. But yet, you're going to be paying less than 200,000. In fact, let me just give an example. We just did a property in Streamwood not too long ago, about 2 months ago. So we purchased a property in Streamwood. I'm going to write these down so that you see this as a test case. We purchased this property for about 130, and rehab was 25. So all in is 155. Okay. All in 155. Okay. And then we rented the property for 1770. Okay, so it obviously meets the 1% rule of thumb. So if I was to apply the 1%, 1% rule of thumb would be that we would need to collect at least 1550. Okay, but since it's the 5th strongest rental market, we're collecting 1750. Therefore, this property cash flows about $350 to $400 per month. Okay. Positive cash flow. So the tenant pays for the mortgage, all the utilities, water, gas, electric, and exterior maintenance, garbage removal, landscape, and snow removal. Okay. So these cash flows about 350 to 400. In other words, the return on investment is infinite, right? Because we have very little money in the property, but yet the tenant pays for everything. And that's the power of rentals, friends. If you want to become financially free through real estate, you must own rentals. It's through ownership. Okay. If you do flips and wholesales, you will not become wealthy via real estate. You're going to be collecting nice paychecks, but you will not become wealthy because for that, you've got to leverage from other people's money and other people's time. And for you to do that, guess what? You have to own rentals. So right now, make sure you copy these top rental markets for B areas. Now let's quickly do the same exercise for B areas, C areas. Now, let me just reset the search and we're gonna do exactly the same thing for C areas. So we're gonna identify the top rental markets in C areas. So I'm going to put it in the chat now so that everyone has these markets. Top C rental markets. Okay. So again, we're going to go over the same exercise. We have the list. Now, all I need to do is I'm going to sort by most expensive rents, but we're going to be looking at the purchase price that it still needs to be under 200,000. Okay, boom. We hit the first one, friends. This is Chicago Rich. So number one for C areas, Chicago Rich. Okay, now let's find number two. So I go down the list, boom, we have another one. Worth, okay, Worth is kind of far. So, but it's the second strongest rental market, okay? Then we're gonna go down the list. We have 200,000, 500,000, 198. Okay, Justice. We're gonna rate this number 3 rental market in the C categories. Let's go to the next page. Then we go down the list, 210, 207, 180. Bingo. So Plano. Okay, so number 4, Plano. Now let's do a couple of more, because those areas are pretty far for most of us. So number 5, bingo. Here's another one, Midlothian. Midlothian is pretty hot market. Midlothian. Okay, let's just find as a bonus probably 2 more. Okay, so next we have Glenwood and Stone Park. Here we go. Glenwood and 7 Stone Park. Okay, friends, so it is that simple. So without breaking your head, without doing driving for dollars, you are able to identify where you need to invest. If you're going to be wealthy in real estate, these are the top markets, okay, where you need to put in your money. So if I were you, friends, I would focus on the B markets, okay? Why? Because they're going to be more marketable. Your rents are going to be higher. And yet, guess what? You can still pay less than 200,000 for a B market, which is way better than paying the same amount for a C market. Does that make sense? So I rather, let's say, invest 150,000 in all SIP, that we're going to be collecting about 1,800, than maybe investing the same amount in Midlothian. So Midlothian, the purchase price is about the same as all SIP, but yet the rent is $1,525 in Midlothian versus 1,800 in all SIP. So I'm going to write that down, okay? So all SIP is about 150K, and then you're going to be collecting 1,800 in rent versus Midlothian, which is 157, the median sales price, and you're going to be collecting about 1,500. So what would you do? Would you invest 150,000 in all SIP and collect 1,800, which is a B area, better infrastructure, better school, less crime, versus Midlothian, investing about the same amount, but collecting about $300 less, right? So it's a no-brainer, friends. You've got to focus ideally on B markets, but let me give you another tip of advice. The way you need to do your investing is that you're going to need to draw a map, okay, that has a radius around where you live. So let me do this. Map developers. Okay, so we're gonna draw a circle. This is really cool. I'm gonna give you this link for everyone. I'm gonna put it on the chat. Bingo. So the way it works, friends, is you type in your address. I'm gonna put in a random address, 4740 North Cumberland. This is in Norwich, okay? And then you're gonna be drawing between a 10 to 15 mile radius. I'm just gonna do a 10-mile radius for sakes. So what the map is going to do is, you can zoom in, it's gonna put in the center where the property, where the address is. In this case, it should be your address. Now I'm gonna maximize this, okay? So what you need to do is identify all the markets around that area, okay? And then start looking at them, let's say Little Village, North Londale, and so forth. Any of the areas that are around your neighborhood, okay? Look them up in ChicagoDealVault. Very simple. How do you look them up? Just type in the name right here. So I can clear, and let's say I want to know more about North Londale, for instance. What type of area is that? Boom, North Londale. Area type D. And then you can just open up the report, but just go over the radius from where you live. Why is this so important? I'm gonna tell you. If you're gonna do flips or rentals in areas that are farther away than 10, 15 miles from where you live, they're gonna become unmanageable. It's too far. You're gonna be driving over an hour. So when you need to talk to tenants, prospective buyers, contractors, appraisers, inspectors, you name it, it's just gonna be very complicated, right? And not only that, but if you work with certain contractors, there are certain contractors that work in areas. So if you go way beyond your area, contractors may not be willing to do work. Let's say if you have broken water heater, right? There are certain HVAC people that they will not drive 10, 15 miles from where you are. Why? Because they have a lot of business in that neighborhood, right? So they don't need to go that far. So you're gonna be struggling getting contractors to far away locations from where pretty much you are, your vicinity. So make sure that you use that tool to draw a 10-mile radius from any area, okay? And then based on that, start analyzing the areas, because again, let's say Worth, right? Or Worth, well, let me pick a better one. Let me pick Hillside, okay? Hillside is near Oakbrook, Westchester. So it's a great area. So if you live, let's say, by O'Hare in Schiller Park, this is a manageable. So it's about a 5-mile distance. But if you live in Will County, right? Hillside doesn't make any sense. Even though it's a B area, it's the second strongest rental market, it doesn't make sense for you because you're going to be commuting hour and a half to Hillside. So it does not make sense. We identified the top B and C rental markets, but again, you need to draw a circle from where you are, okay? Because if you start driving over an hour and 30 minutes, friends, it will just be a headache, okay? And especially when you're starting in real estate, you've got to make sure that you oversee pretty much everything, the entire process of either a rental, a flip, or helping your client so that it's successful, okay? Are there any questions on the line so far? You can send them via the chat. I posted the top areas, top 10 areas, the tool to do the draw, to draw the radius. Are there any questions on the line? So it is very simple, friends. So what we've done is exactly that. We drew a 15-mile radius from where we live. And then based on that, we identify the BC areas. And then we're also tapping into some A areas. So let me give you an example. One of my favorites is Des Plaines. We live by O'Hare in Schiller Park. So Des Plaines, as you can see right here, area type, it's an A area. The purchase price, look at this, sweet spot to buy a single family home is $250, okay? So we've purchased a 3-bedroom, 2-bath house for $160, okay? We're collecting $2,000 in rent. So it's a super strong rental market. Des Plaines, and yet you can still find great deals in Des Plaines. It's a very desirable area. Location, obviously, there are certain things that you need to be aware of, despite the fact this is an A area. Okay, so I'm going to open up the report just to give an example. Des Plaines is near the Des Plaines River, so you need to watch out for floodplains. Okay, so let me just show you the geographic location. So this is Des Plaines. And the Des Plaines River runs right here. It runs through, let me make it a little bit bigger. As you can see, this blue line right here that goes through the Cambrise Woods, all of these. This is the Des Plaines River. So you've got to be aware that if you're looking at a property near the river, make sure that you check the floodplain. Okay, because some insurance companies may not insure your property, or insurance might be several $1,000s, okay? Or it's just probably better not to buy it in a floodplain, right? Because you're going to be struggling with flooded basements, sump pumps, and so forth. So that's something to keep in mind, but we make you aware of this, okay? So factors that will affect your property values. Something that you also need to look into when identifying areas are taxes, okay? When you buy rentals, there are areas like Flossmoor, Country Club Hills, where the taxes are outrageous. For a single family home, you're gonna be paying $8,000, $9,000, $10,000, which pretty much is a deal breaker in many properties. Why? Because that's just gonna increase your, it's gonna kill your cash flow, because you're gonna be spending about $700 just in property taxes a month. So that will just kill your cash flow for a rental, okay? Another thing to keep in mind is that some of these places like Country Club Hills, the property types are pretty big. So they are usually over 2,000 square feet, which means that your rehab is just gonna skyrocket. So you've gotta focus on properties under 1,500 square feet. When you start going over 1,500 square feet, your rehab expense, your holding cost is just gonna go over. It's gonna go very high. Let me give you a rule of thumb. If you wanna just have an idea, rough idea of what the rehab is gonna be for a property, just take the square footage and multiply that by 2. Let me give you an example. If the property is 3-bedroom, 2-bath, about 1,500 square feet, multiply 1,500 square feet times 2, that's 30,000, or by 20, because it's $20 per square foot. So that's 1,500 square feet times 2. It's a 30,000 rehab. But let me tell you, with the assumption that you're doing a light rehab to medium. What does that mean? You're doing upgrading floors, kitchen, bathrooms, light fixtures, and paint. That's about it, okay? You are not putting a new roof, replacing the windows, touching foundation, rewiring the electric system, redoing a plumbing system, or installing a new mechanical system, HVAC, water heater, condenser. No, because every time that you touch one of those systems, your rehab is going up by 10,000. New windows, 10,000. New roof, 10,000. So you've got to keep your rehab light to medium for that rule of thumb to work. Remember, multiply square footage times 2. So when you buy properties that are about 2,000 square feet right off the bat, your light to medium rehab could hit 40,000 easily, okay? So if you're gonna do a flip or a rental, right, your rehab, your holding expense, everything goes up very quickly. So it's just gonna eat up into your profit, and it's just a lot riskier. So that is why the sweet spot is to buy properties all in about 150,000, and then under 1,500 square feet, just for the numbers to make a lot of sense. And let me just give you another rule of thumb. For the numbers to work on rentals, banks are going to be looking at least having 25% equity. What does that mean? I'm gonna write this down. So banks are looking at 25% equity when you're going to refinance or cash out. So what does that mean? Okay, so all in, which is the purchase price plus rehab, should be no more than 75%. Example, 150,000, okay? All in, but it needs to appraise at least 200,000. Okay, so that means that you can purchase the property for, let's say, 120, and your rehab is 30,000. So all in is 150. So the property better appraised for at least 200,000. Okay, so when you have that kind of equity, you're gonna be able to pretty much refinance your loan, because when you purchase a property, especially if you're talking about distressed properties that utilities might not be on, shut off, they're not pretty much in livable condition, you need to work with I'm gonna write this down, asset-based lenders, that they're gonna be looking at the property itself, not so much at your client's history or credit. They're going to be looking at the asset itself. And we have two types. We have the hard money lenders and private money lenders. Okay, so primarily the only difference is that hard money lenders are big institutions like Renovo, Barner Capital, Lima Capital, Chicago Funding, constructive loans. They're huge institutions with a lot of cash backing them up. So versus private money lenders, they're individuals who have a lot of money. That's it. They decide to stay passive investors, so they give you money in exchange for a return. They're both going to charge about 12% interest rate, 2 points. 1 point is just 1% of the loan, and it's a short-term loan, about 4-month term. And then they give you the money, 90%, up to 90%, I'm gonna write this down, 90% for the purchase of the property, and they're gonna finance 100% of the rehab, okay? This is how you leverage from other people's money. So they give you the money for the purchase and the rehab, and then if you're gonna keep it for a rental, then you need to refi. You need to refinance with a conventional lender. Conventional lender, okay? Conventional lenders are like the big banks, Chase, Bank of America. Our preferred conventional lender is Homebridge. So those are the banks that are gonna require you to have at least 25% equity for them to do the refi, or if you wanna cash out, they just need you to have 25% equity. So it is, we just touched briefly on funding because you need to understand the numbers, especially when you are doing rentals. You need to make sure that the 1% rule of thumb applies. So what does that mean? If all in, that means the purchase price plus the rehab is 150,000, you should collect 1% of 150,000, which is 1,500 in rent, okay? If you don't collect 1,500 in rent, then your numbers are not going to work, which means that you won't cash flow positive, okay? Are there any other questions on the line? Something that, let me show you, in ChicagoDealVault, we're gonna give you, when you look at a property, it could be, we give you off-market properties, you can search the MLS. The difference is when we search the MLS, we're gonna be doing the real-time flip and rental analysis for you. So let me show you what that looks like, okay? So I'm gonna open up a pre-foreclosure, okay? I'm just gonna randomly pick a property that is in pre-foreclosure, okay? So this is an example of a property that is in pre-foreclosure. So when you look at a property and you analyze a property, you need to know 3 numbers when you analyze it. And you need to analyze a property in less than 1 minute. If you're taking more than a minute to analyze a property, that's a problem. So you need to know the after repair value right here. How much can you sell the property for after you've done all the repairs? The second thing is, how much are you gonna spend in rehab? Again, we give you this range that is based on the square footage and the location and the size of the property, assuming that it's a light to medium rehab in a BC area. Those are all the assumptions. You always need to see the property from the inside. If it's a gut rehab, this range is not gonna work, okay? And then finally, the third number that you need to know is how much are you gonna be paying? What's the most you should pay for the property? And that's gonna be driven by your exit strategy. If you do a flip, a rental, or a wholesale. As you can see, wholesale is the lowest offer, okay? Because you need to leave meeting the bond for the flipper or the rehabber who's gonna keep it for a rental, meeting the bond, okay? If you do a rental, that's the most forgiving offer, 118. Why? Because you still have time for the property to appreciate, rents to increase, so it's the most forgiving. If you're doing a flip, it's a lot lower, 100,000. Why? Because you need to be making at least a 20% profit on the flip. If you don't make a 20% profit on the flip, you should not even do it. Does that make sense? That is why you need to have enough meat in the bone. So you need to know those 3 numbers, the ARV, the rehab, and the max offer, which is what I love about the system, guys. So you don't need to think, create, or do anything. It's all right here. And for those of you who are brokers online, so in DealVault, with a click of a button, you can pull the comps. So this happens to, well, we don't have enough information on this off-market property, but for a property that we know the number of beds and baths, we can pull the comps in seconds. Unlike the MLS, it takes about 10-15 minutes to do a CMA. So let me just show you, try to pull a property. So this is a property that has 4 bedrooms, 3 baths. So when we scroll down to the comps section, all we need to do is click on search. What we're gonna do is we are going to pull all the comps that sold in the last 6 months within a 1-mile radius, and you can change these, okay? 1-mile radius, 6 months, and then you can change, you know, 3-bedroom to 4-bedroom and so forth. This is gonna pull all the comps, and then you can pick and choose the properties that you wanna pick for your CMA. But we do this overnight, so that is how we are able to come up with the ARV of about 338,000. So we pull the comps for you overnight, and as you can see, there are a bunch of comps right here, and we plot them out on the map. So you have the ability to see them. If you click on view details, you can pick and choose the properties that you like for your CMA, right? So this has been rehabbed, fairly nice. So this is a comp. So what we're gonna do is, let's close that off. We're gonna be updating the ARV, 341. So we pretty much automate the CMA process in DealVault. Now, what's really powerful, friends, if you want to make an offer to one of these properties, if it's MLS, with a click of a button, I'm not going to quickly show you. I'm going to look in one of the top rental markets, Berkeley, right? Let's say Berkeley, remember, we should buy a property for less than 160 or so. So I'm going to search the MLS right now for a property under 175,000. So very, very fast, okay? So this property is for 129, so that catches my eye. It looks brick. This is a 3-bedroom, 1 bath. It looks really good. The only thing that I see is if I zoom in the map, it's very close to the highway, okay? Remember, location, location, location. But right off the bat, if you're looking at the MLS, you have no clue what the ARV is, you have no clue about the rehab, and you have no clue how much to pay for the property. No worries. We're gonna give you the ARV, 219. The rehab is gonna be between 20 to 30, assuming it's a light to medium, remember. And then we're gonna tell you what your top offer should be depending on your exit strategy. So if you're gonna do a rental, 151, flip, 129. So technically, we could potentially buy it as is for 120, and we're gonna have enough room in the bone to make a 20% profit on the flip. But here the problem that I see is the location, right? It's almost on top of the highway. Let me just click right here on a street view, and I'm sure that this is almost, yeah, you see here up there, that's the highway. So I'm sure that they have some noises. So this is a property right here, which is backing out to the highway. So I'm sure that, you know, noise is an issue, being so close to the highway. But that's something to keep in mind. If you want to make an offer, let me show you the power of this, because all you need to do is put in the purchase price, when you're going to close, and the earnest money. And guess what? If your clients use DealVault, the offer is going to come to you. Okay, this is going to have your client's contact information, and the last page is going to have your brokerage information. So by default, right here is going to have your brokerage. Your client is going to have your brokerage contact information. You're going to be the buyer's broker, and then they can put in any attorney or lender, and this is the listing agent. So what's really powerful, friends, is that we're gonna help train your clients on the system, so we free up your time, okay? We take on the overhead of, you know, getting your client up to speed on analyzing the properties, understanding the areas, and making offers, right? So all you need to do is you're gonna get an email with the offer to negotiate the deal, right? Present this offer to the listing agent, Karen. That's simple. So this is how we're gonna help save you time, and we're gonna make your clients more productive so they get more deals and you make more commission sales revenue. That's simple. So in the settings, let me show you. When we configure your client's portal, right here, broker, buyer's broker, we're gonna put your brokerage information right here. So when they make an offer, it comes to you, okay? Right here, we can upload the proof of funds, articles of incorporation, operating agreement, any of the legal documents that we can include to the offer, so that when you get the 7.0 contract already signed, an initial by your client, because we are going to upload their initials and signatures. So there's no need for DocuSign. The contract is already signed right here, as you see, line 520, your client's signature, and then it's got the initials, okay, on every single page. So you don't have to do anything. You're gonna need, you get an email with the 7.0 contract, your client's proof of funds or pre-approval letter for you to present. So we're gonna save both your client and yourself a lot of time. We want them to do more deals. We want you to increase your sales revenue. Are there any questions on the line? You can either unmute yourself or post the questions on the chat. Any questions so far? Okay, friends, so if no further questions, I just want to quickly summarize what we did today. We identify, yeah, go ahead.
Oh, wait. I'm sorry. Can you hear me now?
Yeah, I can hear you.
Hey, sorry about that. Hey, I really love your presentation, by the way, because it is a very great resource to basically find profitable properties to generate some revenue fairly quickly, because all the analytics are right there for you. And then it actually provides a lot of information for you to dump analytics into it, making it even stronger over time. So thank you for that. I actually had two questions. One, first of all, because I'm sure this is not a free service. So how much is it?
Oh, okay. So let me tell you. Great question. So you all are going to get it for free today for 30 days. And then after the 30 days, the retail value, if you go to our website, ChicagoDealVault.com, is 190, but we're going to lock you in at 140. Okay. And then, so let me just show you. Sign up. I can just click on sign up or just scroll down. Let me show you. So 190, or if you do the yearly, it's 1440. But when you sign up today, which is free, so nothing, if you decide to stay, we're going to give it to you for 140. We're going to lock you in at the 140 per month. Or if you decide to do the yearly, it's going to be equivalent to 90 a month, okay, if you decide to stay. 90 a month or 140 if you decide to stay after the 30 days. So we're going to train you unlimited training. As you can see on the system, we have a green button on the upper right hand corner, schedule training. You can schedule as many trainings as you want, personalized. They're all free, okay? Or if you want us to bet a property, right here, ask a pro. Great question.
I guess, and then my second question, well, a follow-up question, if you may. Is it? Do you mind if I follow up with that?
No, yeah, of course. Tell me.
Sorry. The second question is that, okay, so is there anything that I have to put forth in order to sign up for that 30 days?
Yes.
But I really do want to get to using it and seeing its functionality. I guess I know that after 30 days to call and cancel things sometimes makes it a little bit difficult, if not impossible, and then things happen in weird ways. So I'm just making sure that doesn't happen either.
Right. So I'm going to send you the link right now via the chat. This is how you can
I'm actually
sign up. You can sign up. Just make sure that you select the special Chicago Deal Vault package. So the package, I'm going to type it in the chat, is Chicago Deal Vault. And then the promo code is web. And then you can send us, you're gonna get an email with your credentials, okay, right away. And if you have 2 clients of yours that sign up, your membership is free, okay? If you have 2 clients of yours, you don't have to pay for DealVault if you bring us 2 of your clients. But right now, you can get it for free, okay?
Question, do you have a personal phone number, FYI?
Yes, so this is, I'm gonna give it to you right now. So when you go to Chicago DealVault, it's right here, 312, and I'm gonna put it on the chat, 312. This is how you can reach me or our team. We work 7 days a week.
Like you're supposed to, sir.
7733, okay. This is how you can get in touch with myself, or we have two full-time trainers.
Okay, what's your name again? I'm sorry.
Oh, my name is Hugo. I'm gonna write this down. Hugo Galicia. Hugo Galicia. Okay.
Okay, and the last thing that I wanted to do is I want to ask you, is there a way to, I understand the buying and flipping homes, and honestly, me and my business partner, we have been participating in basically short-term rentals and Airbnbs for a little bit, and we're actually gotten quite good at it. One of the things that I'm trying, I used to actually do foreclosures and buying and flipping homes way back in the day. So I'm familiar with going up to the Daily Center and pulling all the probate records and making sure that you can delve through them and get all that personal information. Is there a way that I can get a hold of homes?
Yeah, of course. Look, check this out.
Yeah.
And then even probates, right? So we skip trace every single one of them. So let me just
that's what I'm talking about.
Skip trace is embedded in it. I'm glad you asked. So for any property, I put many. When you hover over the name, you see Sergio Ochoa. Hover over the name, and boom, we give you their email, phone number, cell phone number, everything.
Okay.
and it's embedded. So that's how we connect with the owners directly. Okay.
Okay.
And it's free. It's embedded in it. So make sure that you sign up, go to the link below, select the package, special Chicago Deal Vault, promo code is web. And then the second page will take your credit card, but we won't charge anything. We'll just hold it. And again, you can cancel before the 30 days. That's not a problem. Even if you go over a day or so, just let us know. Email us, call us. We'll cancel your membership. So.
And you said the promo was web?
Web, yes, it's right.